Hello, welcome. This is SeeWing Yee from the Yee Real Estate Network. We specialize in helping with out-of-state investors, regardless of where you are located in any of the 50 states, to buy out-of-state turnkey remote investing in the most favorable markets, which will provide you with cash flow. We provide a turnkey investment methodology. We have done mostly everything for you. We have done the advanced research and due diligence to help you to enter into a specific market. We have teams of turnkey providers, our real estate loan agent, consultant in a particular market. We have property managers that can manage your property remotely. We have title company, investment loan agents, insurance companies, the whole 9 yards to make your out-of-state investments very efficiently and very methodically. At some point in time in the future, your portfolio of multiple rental properties is pretty much done autopilot, where you can work smart, not work hard. You could buy however property you can buy at a financing at 20 to 25% down payment, and then you can achieve your retirement at some point in the future where you will take control of your finances and do whatever you need to do at retirement without needing a paycheck to do it. Right, with that said, what about to mention to you, this is a very short video as always. I am not a tax or licensed financial advisor. The information I'm providing to you is purely for educational purposes only. You need to consult with your own personal financial advisors to go over your specific situation as it applies to your goals and objectives. So without further ado, I'm going to talk about some tax benefits, specifically cost segregation. All right, so that's what I'm trying to share that with you. So in fact, let me go back to the all right, here it is. Okay, but before I talk about cost segregation, just bear in mind that a income property, specifically single family home residential investing methodology, is a multi-dimensional asset class. What does it mean is you're able to obtain, when you buy investment property, hopefully in the right place, right area where there's cash flow, you're getting income, right? You're getting rental income, cash flow. You're getting a appreciation potential, right? And especially when you invest over the long term, historically, real estate will give you 6 to 8% annual appreciation. So it's a good long-term wealth accumulation strategy. And then you're getting leverage. You're getting a loan, right? You're getting a loan at the most favorable rate. I mean, you have heard the term OPM, other people's money? I mean, you're almost getting free money by leveraging your asset purchase with 75% or 80% loan to value. You're only putting 20 to 25% of your at-risk money, which is the down payment, right? And you are able to encourage a lender, a mortgage company to give you that loan because you have good credit. I mean, amazing, especially right now, the mortgage interest rate is at a historical low rate. So it's almost free money. I mean, what more can you ask for? And also you're getting your renter. Your renter is paying off all your rental properties. If you're getting $2,000 monthly rent and your renter is paying off your monthly mortgage, your monthly taxes, your monthly insurance, your monthly property management fee, and 5 to 7% factor in of your rent to allocate towards any kind of potential vacancies and potential maintenance and upkeep associated with managing your property. So at the end of the day, your monthly rent ideally is higher than your monthly expenses and debt obligation. Therefore, you can achieve, a fair amount of monthly positive cash flow and then, that's what it's all about. So, okay, let's segue back to the crux of our presentation, which is cost segregation. Now, again, this my disclaimer is I'm not a tax advisor. I'm giving you this information for with a disclaimer. All right. So cost segregation is another component of reducing your taxes subject to taxation, because your income that you generate from renting your property, technically speaking, is taxable at your ordinary tax rate. Your ability to reduce your rental income on your tax return on an annual basis by owning a rental property, you're getting depreciation anyway. Your depreciation normally is allocated over 27 and a half years. So, you get a little bit of depreciation, which is a passive losses, paper loss to offset your, ordinary income, which is good, subject to limitation. So, depreciation is a long way of systematically to write off your property over, what the IRS called 27 and a half year, expiration period write-off. But the definition of bonus depreciation and cost segregation allow you to accelerate your depreciation much quicker than the 27 and a half year of systematic annual depreciation, right? So if you could, the cost segregation allow you to look into your building, the structure of your property, and allocate any kind of other items that are attached to the inner part of the property, where you can some personal items such as whatever landscaping or furnace or kitchen items or the refrigerator, the air conditioner, the furnace, all those. If you could, cost segregate those items inside a house, and some of these items are, you can write it off within personal items inside a house, and you can write off in over 5 years. A furnace, you can write off, for example, maybe over a 10-year time frame. It's called accelerated appreciation. So applying the concept of cost segregation allow you to, on the next few years, the next 5 to 10 years, instead of 25 years, instead of 27 and a half years, right? To have a quicker write-off, higher tax deduction to offset against the passive income associated with your rental properties. Okay, here's the bottom line. Okay, this is going to be a quick presentation. Obviously, I can't spend 2 hours. If I want to invite a real tax advisor, a licensed tax advisor, to talk about cost segregation, it'll take 2 hours or more, right? So this is a high level explanation. It may apply to a lot of you. It may not apply to some of you. There's a cost segment, right? You have to pay a licensed tax advisor to obtain a cost segregation analysis. What the money you pay them, I don't know how much it costs, depending on how many properties or what's the size of the price of the property you want to do a cost segregation. Sometimes if you have a small little rental property, costing $50,000 to $100,000, you may not justify to do a cost segregation, because the minimal tax benefit from such a small property may not exceed the cost of paying a tax advisor to do the cost segregation analysis. Does it make sense? So with that said, you're asking me, now that you're probably going to ask me, Mr. Yee, what's the best type of property, or how many properties should I have before I could justify getting the tax benefit that can exceed, the cost of paying somebody to do the segregation analysis? So One example is if you have a, I don't know, there's no hard and fast rule about it. Okay, I want to make sure that you're getting this. All right, so you see this clearly. So what you have in front of the screen you're seeing is that, I mean, there's no really threshold, but in my personal opinion, if you have anywhere from 500,000 or $1 million worth of real estate portfolio, that may justify you to do a cost segregation strategy. Does it make sense? So first of all, if you have a, if you have like, if each of your single family home residential investment property costing you just acquire for 200,000, for example, and you have like 4 of those, if you acquire at kind of in the same time, in the same year, for example, then it may justify you to do cost segregation. Or I'm gonna give you a quick example. Or if you have the wherewithal to buy a 4-plex, as in this example, that costs you like 725,000 in this case. So for this one property alone, based on the purchase price, may justify you to do a cost segregation. Okay, I'm not going to go through the numbers and all that, but this example, by the way, this is a real example. You saw it in Texas, right? You can buy a brand new 4-plex for 725,000, brand new in a very good rental market in Central Texas, San Antonio, for example, 750,000, and the projection rent for all 4 doors, as you can see, is around 6,000 for all 4 doors. So each door will give you like $1,500 in monthly gross rent. That will be ideal. Then you do a 25% down payment. So you could get a positive cash flow pretty nicely at the end of the month for $1,000, right? So, so with that said, so 725,000, and when you break it down, you allocate the internal of the property, identify the furnace, the landscaping, the front yard, the pipe, the kitchen items and furnitures and stuff. You will see some 5-year, 10-year, or 15-year cost segregation analysis. So as a result, if you're able to successfully do it on this type of property, then all this cash flow, I mean, you could pay very little taxes on this annual cash flow, right? So, I mean, that's what I'm trying to prove, all right? So I can't go any further because I'm not giving tax advice, but just goes to show you there are so many different ways to really make your risk investing to be truly amazing strategies, right? You get income, you get appreciation potential, you get the tenant to pay down your property, right? That's a great scheme. And then you get some multiple tax benefits. Wow, so many things to talk about, but run out of time. Thank you so much for attending. Hope this helped. I'm just sharing with you one small component of the multi-dimensional asset associated with owning at least one rental property, and hopefully a single family residential, duplex, triplex, and 4-plex will be ideal as well, given, it all depends on your goals and objectives. All right, so thank you so much. This is SeeWing Yee from the Yee Real Estate Network. Thank you for attending. Have a nice day. Bye-bye.